Meta just reported one of its strongest quarters in years. Revenue surged nearly 30%. Advertising revenue continued to grow. Daily active users reached another record high. And management even raised its revenue outlook for the next quarter. By almost every traditional measure, this should have been a quarter worth celebrating. But Wall Street saw it very differently. Within hours of the earnings release, Meta's stock plunged more than 7% in after-hours trading, wiping out billions of dollars in market value before the next trading session had even begun. So, what changed? Did investors suddenly stop believing in Meta? Or did Wall Street realize something that most people completely overlooked? I believe this sell-off isn't really about Meta's earnings. It's about something much bigger. For the past 2 years, investors rewarded companies for spending aggressively on artificial intelligence. But after Meta's latest earnings, Wall Street may have changed the rules. And if that's true, this isn't just Meta's story. It could reshape how investors value every major AI company from this point forward. If you looked only at Meta's financial results, you probably wouldn't understand why the stock sold off so aggressively. Revenue grew by nearly 30% year over year, driven by continued strength in digital advertising. Daily active people reached another record high, proving that Meta's ecosystem continues to expand despite intense competition. Even more encouraging, management raised its revenue guidance for the next quarter, signaling confidence that business momentum remains intact. On paper, this was exactly the kind of earnings report investors usually reward. Strong revenue growth. Growing user engagement. Healthy advertising demand. And an optimistic outlook. By almost every traditional metric, the numbers said buy, not sell. So why did Wall Street react in exactly the opposite direction? To answer that question, we need to look beyond the headline numbers, because the figure that changed the entire story wasn't on the income statement. It was hidden somewhere else in the financial statements. If revenue wasn't the problem, then what was? The answer wasn't hidden in Meta's growth. It was hidden in its spending. Alongside its earnings report, Meta significantly increased its capital expenditure guidance to between $130 billion and $145 billion for this year. That's one of the largest investment programs ever announced by a public company. According to management, most of that spending will go toward AI infrastructure, building massive data centers, expanding computing capacity, and developing the next generation of AI models. For Meta, this is an investment in the future. But for Wall Street, it immediately raised a different question. Not, can Meta build great AI? But, how long will investors have to wait before this investment starts generating meaningful returns? That single question changed the entire conversation. Because once spending accelerated, investors stopped looking at revenue, and started looking at cash flow. Let's think about this from Wall Street's perspective. Meta isn't just increasing its investment in artificial intelligence. It's planning to spend between $130 billion and $145 billion on capital expenditures this year alone, an amount few companies in history have ever committed. The problem isn't that Meta is investing. The problem is uncertainty. No one can say with confidence exactly when these investments will begin generating meaningful returns. Will it take 2 years? 5 years? Or even longer? The larger the investment, the higher the expectations become. And that's exactly where investor psychology begins to change. Wall Street doesn't simply reward companies that spend the most. It rewards companies that can prove those investments will eventually create shareholder value. For Meta, that proof has now become far more important than the spending itself. And that's why investors quickly shifted their attention away from revenue growth, and toward one metric that ultimately determines valuation: free cash flow. For years, investors rewarded companies that delivered faster growth. But when capital spending reaches this scale, the market starts asking a different question. How much cash will actually be left for shareholders? That's where Meta's earnings became far more complicated. While revenue remained exceptionally strong, the company's massive AI investments are expected to put significant pressure on free cash flow in the near term. And that's a critical shift. Because in the end, a company's valuation isn't driven by revenue alone. It's driven by the cash the business can generate after funding its investments. The stronger the business, the higher the expectations. And when free cash flow comes under pressure, even an outstanding quarter may no longer be enough to satisfy Wall Street. That's when the narrative begins to change. But there was another reason investors reacted so quickly: they've seen a similar story before. Investor psychology is rarely driven by numbers alone. It's also shaped by memory. Back in 2022, Meta asked investors to trust its long-term vision for the metaverse. The company spent tens of billions of dollars building a future that many believed was still too far away. As confidence faded, Meta's stock lost more than 70% from its peak. Today, the story is different, but the memory remains. Once again, Mark Zuckerberg is asking investors to be patient while Meta invests heavily in the next technological platform, this time, artificial intelligence. The market isn't saying AI is the wrong strategy. It's asking a much tougher question. How do we know this investment will create better returns than the last one? That's why this earnings report triggered more than a valuation adjustment. It triggered a psychological one. And that's when I realized, this sell-off wasn't really about Meta anymore. This is where I believe the real story begins. For the past 2 years, Wall Street rewarded companies that invested aggressively in artificial intelligence. The assumption was simple. Spend more today, dominate the AI market tomorrow. But Meta's earnings suggest that assumption may no longer hold. Today, investors are asking a completely different question. Not, who is spending the most on AI? But, who can generate the highest return from every dollar invested? That's a fundamental shift in investor psychology. Wall Street isn't losing confidence in AI. It's becoming far more disciplined about how AI investments are valued. And if that mindset continues, every major AI company, not just Meta, could soon be judged by a very different standard. And that's exactly why this sell-off could have implications far beyond Meta itself. If my interpretation is correct, then Meta isn't an isolated case. It's the first major test of a much broader shift. Over the next few quarters, every AI leader, from Microsoft and Alphabet to Amazon and other hyperscalers, may face the same question from investors. Not whether they're spending enough on AI, but whether those investments are producing measurable returns. That changes the investment debate completely. The conversation is no longer about building the biggest AI infrastructure. It's about proving that AI can generate higher earnings, stronger cash flow, and better returns on capital. In other words, Wall Street is no longer paying for AI promises. It's starting to pay for AI results. And that may be the biggest message hidden behind Meta's earnings report. Transition to slide 9. But here's where I think the market may be making an important mistake. But here's the other side of the story. What if Wall Street is focusing too much on this year's spending, and not enough on the business Meta could become 5 years from now? Meta isn't investing billions of dollars just to build larger data centers. It's investing to strengthen one of the most profitable advertising platforms ever created. If AI can improve ad targeting, increase user engagement, and help businesses generate better returns on every advertising dollar, today's spending could become tomorrow's competitive advantage. History has shown that markets often underestimate companies making large investments before the financial benefits become visible. That doesn't mean Wall Street is wrong to be cautious. But it does mean investors should ask one more question. Is this investment destroying value? Or quietly creating Meta's next economic moat? To answer that question, we need to understand what makes Meta so difficult to compete against in the first place. One reason I believe the market may be overlooking the bigger picture is Meta's competitive advantage. Artificial intelligence becomes far more valuable when it's deployed at massive scale. And very few companies in the world have the scale that Meta does. Every day, billions of people use Facebook, Instagram, WhatsApp, and Messenger. Every interaction generates data that helps Meta improve recommendations, personalize advertising, and make its AI models more effective over time. That creates a powerful feedback loop. More users generate more data. More data improves AI. Better AI creates a better user experience. And a better user experience attracts even more users. If Meta successfully executes its AI strategy, this ecosystem could become even more difficult for competitors to replicate. That's why Meta isn't just investing in AI. It's investing to strengthen an already powerful competitive moat. But even the strongest moat cannot justify unlimited spending. So what is the real risk investors should be watching? In my opinion, the biggest risk isn't that Meta is spending too much on AI. The real risk is whether those investments generate an attractive return on capital. History is filled with companies that invested heavily but failed to earn enough to justify the cost. That's why investors shouldn't judge Meta by the size of its AI budget alone. Instead, they should watch for signs that these investments are translating into stronger advertising performance, higher operating margins, improving free cash flow, and ultimately, better returns for shareholders. If those metrics begin to improve, today's spending may prove to be one of Meta's smartest long-term decisions. But if returns fail to materialize, Wall Street's concerns will be justified. In the end, AI spending isn't the investment thesis. The return on that investment is. And that's exactly where my investment thesis begins. So, what is my investment thesis? I don't believe the AI dream has broken. What has changed is investor expectations. For the past 2 years, Wall Street rewarded companies simply for investing aggressively in artificial intelligence. Today, that standard is changing. Investors are no longer impressed by the size of AI spending alone. They want evidence that those investments can generate stronger earnings, healthier free cash flow, and higher returns on capital. Meta now finds itself at the center of that transition. The company isn't being judged because its business is getting weaker. It's being judged because the bar has become much higher. In my view, Meta's long-term success won't be determined by how much it spends on AI. It will be determined by how effectively it transforms that spending into lasting shareholder value. And that may be the most important lesson from this earnings season, not just for Meta, but for every company competing in the AI race. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.